completely reading into this, thinking this is a complete positive move. It absolutely is. Can I get a from around the panel? Who bought SoFi shares this week?
It's about 20% more SoFi.
So on Tuesday, SoFi released a press release in an 8K that said that they were kind of doing two, they called them separate transactions. So the first transaction was they were offering $750 million in senior convertible notes. And then the second transaction was that they were retiring $600 million of a previous senior convertible note deal. So we'll handle these kind of one at a time. Chime in if I get something wrong or if I miss something. So we'll start with the $750 million of convertible notes, which turned out to end up being 862.5 million because they ended up being oversubscribed. But the idea behind a senior convertible note is it's a way that you can fund your company. You go to the markets and you say, hey, we want to take out a $750 million loan. And they say, okay, here's the loan, here's the $750 million. And they're convertible notes because that $750 million in debt can be converted into SoFi stock at some time in the future. And we'll kind of discuss the details probably as we go through here. But the idea is it's debt now, and it's got an interest rate, and the interest rate is 1.25%, which is super duper low in the current market, right? At some point in the future, they can convert that $750 million into $750 million worth of shares. And so that's what the convertible note is in a nutshell. And then at the same time, they had this old debt that was going to come due in 2026, and they issued $61 million approximately. We actually don't know the final number yet. It's still undetermined, but approximately $61 million or 61 million shares they have to issue in order to pay off $600 million in their previous convertible notes. So it's these two transactions that are, I think, probably related, even though they are separate transactions.
Yeah. So the first one is, in my opinion, not too hard to understand, or at least for me to understand, is the fact that they went in to potentially all the way till 2029 to get really cheap debt, 1.25%, at least until they turn that into shares. But for now, 1.25%. And they are replacing a lot of their really high interest debt, like, the preferred shares that they were paying out 12.5%. Can you remind me, Chris, what is the amount that it's going to be rising to? Because I've heard a bunch of different numbers.
So the 17.5 number has been floated from a couple of different sources. If you pull up the actual 10K, what it says is that so I guess they have $325 million worth of preferred shares. And those preferred shares get a special dividend that, since for the last 5 years, has been 12.5%. So if you convert that, you take 325 million and you multiply it by 12.5%, it ends up being just over $40 million. So just over $40 million a year, they're paying in a dividend to these shareholders. In May, that number gets updated, and it gets updated. If the 10K is right, what it says is that it's the term SOFR rate, which I didn't even know what that was before I invested in SoFi. But basically what it is it's just it's a benchmark rate. So it's some benchmark rate, and then you add, it's like 9.95% onto that. And that benchmark rate today is like 5.3%. So if the terms in the 10K are accurate, what it means is that starting in May, or at the end of May, that 12.5% would increase to like 15.5%. And so that bill that would come due would increase by another $10 million every single year. And so what they're doing with these convertible notes is they're paying them off. So they're taking $325 million of that convertible note that they're borrowing, and they're using it to pay off this higher interest debt. So basically they're saving, call it $50 million a year in interest, and exchanging it for paying something on the order of $10 million a year. So they're going to be saving $40 million a year in interest payments.
Was this $40 million a year in their guidance, or is this something that we have to now add on top of it? The full year guidance for 2024 was 95 million to 105 million in net income that they provided at the beginning of the year. They're going to raise that guidance multiple times throughout this year, most likely, just given their previous history of having raised it. Now, SoFi, by paying off this $325 million high interest loan, they are saving $40 million.
they're also lowering other debts as well, which we don't know the exact numbers on that. But
if they're actually going to use it to pay down other debt, I would think that they would actually use it to pay down their revolver. So they've got a revolving credit facility that's also on some variable rate, and I think it's like 7 or 8% right now.
Yeah, I don't think that this would be in the guidance at all. The guidance was soft, but in a typical SoFi way. A lot of conservative assumptions, very much slowed growth rate. And I know on the lending side it makes sense, but with the other sides, it just doesn't. So I don't think it's in the guidance at all.
Well, if it's not in the guidance, then these guys can print 150 million in net income for this year. I mean, 100 was the top range. If they're going to add another 40 million onto that, let's just assume, to be super conservative, that 10 million is their sandbag quota. Like 150 plus, I feel like is so achievable if it's not in the guidance.
I'm going back and forth on this because I'm hearing some people who said that this potentially was in the guide because they said that they expect it includes expected capital market transactions. I don't know if this does fall under the guide, but yet whenever they did make the guide, there's no way that this specific deal would have been set in stone. I mean, it just finished up, right? So who knows? But maybe potentially they knew one way or another that they were going to be restructuring their debt, and maybe they knew approximately where they were going to be able to get a good rate.
I can see how they wouldn't guide on something that's not finalized because it's not finalized, right? Like, and you don't want to put that into your guidance. But on the other hand, and the Compass Point analyst actually pointed this out in one of his notes, is he said, if you look at the guidance that SoFi gave, it actually doesn't add up unless they do some sort of weird, unless they enter capital markets and either pay off their preferred shares or do something else to change things around, because they guided for this 95 to 105 million dollars in what they call net income, but then their guidance for EPS for the year was only 7 to 8 cents. And the way that SoFi does their numbers, the 95 to 105 million would not include that $40 million plus of dividend. If their net income was 95 to 105 and it didn't include the dividend, then the equivalent EPS should have been like 5 to 6 cents, but instead it was 7 to 8 cents. And if you kind of take the numbers into account after the fact, then it ends up equaling out. So again, I could go both ways. I don't know whether it was in the guide. I don't know to what extent it was in the guide. I doubt it was in the revenue guide, kind of like Roy said, because it would be really sandbagging.
The big factor for me too, and you guys have been in SoFi longer than I have. I was tracking it before I invested last May, but not at the detail that you guys were. This is a very conservative company when it comes to guidance. And I don't remember any time when they have guided for anything that wasn't just like 100% sure. And when it's sure, they hammer it.
The idea of an outlook or guidance is based on assumptions, right?
Yeah,
like
you're talking about a company who has in their baked in assumptions the fact that we're going to be like in a heavy recession by the end of the year. Like it could very well not be in the guidance given how conservative they are. Even if there was a slight chance of this thing not closing, or if the numbers being materially different from what they thought they were, like they could have had foresight on the deal, but not the specifics of the deal. And even that alone, just with their conservative nature, could have led to this not being accounted for because they don't know all the details.
So we're not going to see much of it as far as in terms of revenue in Q1, but as a guide for the next quarter, and they revise that upwards, I think that we'll be able to tell based on how they revise a Q2 whether or not this was actually baked in. Is that what you guys would assume?
What I think the big change in any potential margin for these changes for the preferred shares, they're paid out from what I understand on a quarterly basis. So we don't know where that falls, but I'm going to make a bet that doesn't fall between March 9th and March 31st. So, but I don't think it's going to affect Q1.
Regardless, to answer like for your question, Roy, for Q2, they're going to raise their EPS either way. Like if this reflects or if it doesn't reflect, they're just going to raise it either way. So it's going to be, we're going to know though, like if they come into Q2 and they report like 3 cents EPS or 4 cents EPS, it's going to be a pretty educated guess to say, well, probably they're not going to hit 7 or 8 by the end of the year. They're going to hit like 10 or 12.
We should probably talk about the ramifications of the deal for the actual company, right? So why did they do this deal? So number one was to pay off those preferred shares. So basically, like Tannor made a good point on this on one of his videos, where he basically said, so SoFi is taking a page out of their own book and they're refinancing higher cost debt for lower cost debt, right? So that number one helps them, right? That's $40 million less that they have to pay every single year when you're switching out the higher interest free fee for the lower one. The other thing that this really does for the company that helps them out is it helps on their capital ratios, which means that, so SoFi, it's a bank, it can only loan a certain amount of the capital that it has on the books. And they are being very conservative right now. And then the last quarter, they actually increased the capital ratio. So the very bare minimum they could ever get down to is 10.5%, but you never even want to get close to that, right? And they guided in the last quarter, they said, we're going to stay above 14%. They said, we'll end the year above 14%. And they talked about how they're going to stay the whole year above 14%. And they were at 15.3%. In the press release that came out with this deal, they said, if we would have done this in Q4, it would have given us at least 2% increase to that. So instead of being at 15.3%, we go up to 17.3%. Now, that's a lot of jargon and mumbo jumbo. What does that actually mean for the company? It means that they can now continue to grow their loan book every single quarter this year by about $2 billion, which is last year when they were really ramping up originations really fast, and they didn't have as much principal coming off the books because they didn't have as many loans from previous. They were growing their loan book by about $2.5 billion. Every single quarter. So that means, and they're also, now they've got this forward flow agreement that's $500 million a quarter. So basically what this means to me is SoFi can continue to grow their loan book now, and lending, I don't know how it would make sense for it to go down to say 92% of what it was in 2023. If now they can continue to grow their loan book. Now they may take a really conservative stance still and maybe not grow it as much as they did last year, but I can't see an environment where they would just have done this whole deal to free up that capital ratio space and then not take advantage of it somehow.
The ramifications of an extra 2% is massive whenever we were talking about just being roughly 4% away from regulators coming in to put a full stop to the party. So it's definitely important. I think another thing that's important, it's not like SoFi needed to raise capital. They were doing perfectly fine. They probably would have been perfectly fine even with those high interest rates. It just is not as sexy as potentially it is now. Is it dilutive or not? I mean, that's our question. Sorry.
Dilution is a big topic. So the $61 million or 61 million shares they have to issue to pay off the $600 million in loans, that is dilutive, right? So those are outstanding shares that they're going to add to the float in order to pay off that $600 million. If they could have done just the convertible note deal, the new convertible note deal without issuing those shares to pay off the old convertible notes, that would have been a slam dunk. It would have been awesome. I have a feeling, even though they were separate transactions, that they were still somehow not completely independent. I would guess that there is some sort of linkage on the business side between the people who are holding $1.1 billion of convertible notes previously and the ones who are going to be investing in $750 million in convertible notes on the exact same stock later on. I don't know that for sure. That's speculation. But my guess is that they're probably linked somehow.
Well, so the thing that I logically don't understand with regards to that is that 600 million in debt had zero interest. You're diluting shareholders by issuing new shares to pay off something that has zero interest rate right now. Meanwhile, like at the very, and I get it could have been out of their hand. And I'm curious to get your thoughts of like whether this was out of their hand. These institutions were like, pay us back basically, and their hand was forced. But let's say even if they didn't want to tap into their cash to pay off the 600 million, why wouldn't they just make the 2029 convertible notes like a $1.2 billion offering and then use those proceeds to pay off the 600 million instead of issuing shares today?
Just really quick, it wasn't actually it wasn't a free loan. It's rounded down to zero. It's important to know that it wasn't just like, we got free capital or something like that. It was like 0.43% or something like that, which is still low, but we replaced it with a 1.25. Like both convertible notes that we've had have been extremely low interest rates, but they are going to eventually turn to equity.
So part of the reason also is that the capital ratio discussion that we just had, a lot of that capital ratio being freed up is the fact that we're retiring these old notes at 600 million and we're using equity to do that. So that's what's freeing up the capital. It's not necessarily the 700. The new convertible note deal it doesn't really help us with our capital ratios much. The other thing that we should mention is they're actually buying back the $600 million of principal at a discount. So they're buying them back for about $530 million worth of cash. And so that actually helps us. So that's net income that helps the company. So it's like it drops to the bottom line. And it also helps, again, because we're paying it with equity rather than issuing new debt. That's what is freeing up most of the capital, is my understanding.
The capital constraint piece was, one of the key bear arguments 5-6 months ago that was just being hammered like in the news every single day. It felt like so. But yeah, I agree with you as far as those that conversion. Unless they're decently aggressive on the loan side, or they have an acquisition lined up, or they're seeing something in the macro that just looks terrible. I've seen this management execute consistently over the years, and they're phenomenal. And so they have something up their sleeve. We don't know for sure what. Maybe you guys have a better guess than me, but I think they're just going to be aggressive with the loan book there.
Like if it was the same institutions, just thinking out loud about this, the 2026 convertible notes had, I think, a $22 conversion price on them, and those were made back in
2021.
Yeah, so they were never going to hit the 22 price target by 2026. I mean, so if it were those same institutions, they could have probably rolled over to the 2029s, which would have forced SoFi to pay one for the other. But other than that, I just don't see it.
Like, I think at the end of the day, they wanted to pay off the preferred shares. They wanted to refinance some of their old debt. And when they were going through, like, you can't get something for nothing, right? Like there's always another person on the other side. So it's not just SoFi who's negotiating. It's also the people who own these this debt that's underwater for 2026. And they want to be able to recoup some of their losses and other costs, right? They've also been holding these notes since 2021. Interest rates have gone way up. The price of this debt has gone down, right? SoFi was able to buy it back for 89 cents on the dollar. And not only that, they are losing, it's $1.1 billion worth of debt that they issued, or capital that they issued, and they're getting 0.43% interest. They could have that in treasuries and be getting 5.5% interest, right? And so like there's two sides to this deal. So this is my personal opinion. Again, in none of the public filings does it say these two are two sides of the same coin. But my read here is that the fact that it happened at literally the identical same time, that the 8Ks were linked every single time, that even the 138 page like description of the deal has both of those deals in a single press release, in a single 8K. It doesn't seem like a coincidence that these deals happen at the same time.
The parts that I want to talk about, however, and I really need some help understanding, is the capped call part of this transaction. Is this actually going to stop the dilution, or is it only to minimize it, and it's actually dependent on where the stock price falls?
The 750 that they, or I guess 862 that they got from this deal, about half of that went to the 12.5% interest. The other half, 346 million or so, general corporate purposes and retiring additional debt. And then about 78.8 million went to capped calls. The reason for this was to offset dilution. To answer your question, Tannor, just before I go into the call option side of things, they could have adjusted that amount to buy more or buy less. So I think that they have structured it in such a way where if they hit a certain point, they fully offset that dilution. Otherwise, why wouldn't they just buy more of those underlying options to fully offset it? Like, why would they only buy 78.8 million and offset, let's say, 50% if they hit? So I do think that management is aiming to offset the entire amount of the dilution, because there's like another 346 million that they're using for general corporate purposes. I think a lot of people got confused at the cap portion. It's just the call option that they're buying on their underlying stock, so that when the stock hits a certain point, i.e. the point of conversion, I think the note holders can't convert the stock until it's 30% higher than the point of conversion. 954 was the conversion point. I think 1228 or something like that is the point at which the note holders can say, okay, we're 30% above conversion point. Here's our notes. Give us the underlying shares. The capped call portion, the strike price, I believe, is 954, which is the conversion point, at which point SoFi would essentially be making a gain on their call options. And when the note holders want to come and redeem their shares, SoFi sells those call options. They can get the underlying shares from the market. As a result of that, they wouldn't have to issue new shares to create new shares out of thin air and cut everybody's slice of the pie a little bit thinner. But the cap is 2x what the stock price was at closing. So it was 724, and I think the cap is 1454, something like that. At which point, if SoFi hits $14.54, there's no more upside. And again, SoFi doesn't necessarily, they're not gambling their company money on their underlying stock. They just want to hit a certain amount so that they can offset that dilution. So it works both ways.
Call options are not going to just have shares printed out of nowhere. Someone is hedging against that. If the market maker, for some reason, and they won't do a total hedge on all the shares, I know that that's out there, that every single one of these shares will be hedged. That's not how market makers do that. They'll hedge them as they would a typical option. And the higher it goes, the more it'll be hedged up until that cap limit. The other piece with that is if for some reason they're not hedged, then they need to go out and buy those calls on the existing market. So that won't be diluted. So the cap is the net benefit for SoFi. So I understood these as functioning similar to vertical spreads. Up until they hit that certain threshold, nine something, there's not really any tangible benefit for SoFi for this. But the max benefit that they actually have is the 14, whatever was double.
1445.
Yeah, thank you very much. What the double the price, and we can talk about that price action. So basically, if SoFi is at $25 a share at that point when they're looking to redeem these, SoFi, it's kind of like insurance that they have these call options that they have, which will cover them up to that certain price, and then SoFi will have to pay the difference.
They're exposed in terms of dilution, if I'm correct. After
If it goes
14.
above that. In today's filing, it actually said that they bought a number of cap calls that was the same number as the number of shares that they have to deliver. So that was actually in today's call. And they also disclosed that the strike price of the calls is $9.54, which is the bottom price at which the shares can be converted into or sorry, the debt can be converted into shares. And then the cap, which is the top, is for that $14.45 that we've been talking about. So basically between the share price, between where it is right now, we'll call it 70, whatever it was that it closed out today, between there and $9.45, if SoFi stays until 2029 under that $9.45, right, they're unable to convert they wouldn't want to convert them because they'd rather have their debt back rather than have shares, and they're unable to convert them. And so something similar to what just happened now might happen again in 3 or 4 years when they have to they're getting close to this point,
Right.
and they have to refinance, and they have to somehow come up with $750 million of money to pay back to the debt holders, right? That's what ended up happening. So we wouldn't be having this conversation about the $61 million that are being diluted to pay back the old shares if the stock today was sitting at $40 a share, because they would have converted long ago, they would have had their shares, they would have gotten their return, and they would have been happy with that deal. But the capped call is also structured in such a way that if the stock price goes beyond this 14.45, SoFi's upside is limited at that point. And then if it goes past there, there's a possibility that or if they don't hedge or do something else past there, you start to get dilution again. So the idea is up until 14.45, we're covered from a pretty decent amount of the dilution. Like if we're in the range between, call it $12 and $14. And I guess the other thing that came out in the filing today is that the convertible note holders can choose to convert anytime that the stock is above 130% of 954. So that 1228, right? So basically if the stock gets to 1230 and it's there for like 30 days, they can convert anytime they want to after that. That case would have all these capped calls. They would immediately be able to exercise them, deliver the shares, say, here you go. And there's very little to no dilution for us. Let's say the stock goes to $25 by 2026. Am I going to be really mad that that's going to lead to $20 or $30 million or 30 million shares worth of dilution? No, because the stock is going to be at $25 and I am buying it today at $7, right? So if I have a 3 or 4 bagger, I'm not going to be, it's the same way, like the way that I think about this is the same way that like Elon Musk, in order for him to get any of his PSUs, the stock price of Tesla had to double. So in order for us to get to the point at which we're worried about higher dilution, the stock has to double. And that's not really a bad outcome for shareholders, right? So basically the way this works is if you're under 940, or if you're under 954, there's a chance for dilution. If you're above 1445, there's a chance for dilution. And in between there, SoFi is pretty well hedged so that we don't get very much dilution as shareholders when these come due and get converted. But if it's above that number, I'm not that worried about it. And there's a possibility at that point that they could take on other hedges. So the way capped calls work, is a little bit different from covered calls. So most people are kind of familiar with covered calls, which means like if the strike price goes, or if the share price goes beyond some certain level, you have to give the shares to the person who bought the calls. A capped call is very similar in nature in the way that it's structured, but the difference between between a covered call and a capped call is a capped call automatically executes at the price.
Is there any reason why these note holders wouldn't convert at the earliest time versus waiting till $25?
I guess the incentives are there. I guess if I was a note holder, right, I don't see. I don't know what the incentives are, right? Like I'm trying to think from their perspective. Would I
Unless
want to
you're
convert
holding
at
for
the
the
earliest?
1.25%.
So
Yeah,
one
right.
thing,
You're not really holding for the interest. You could
Yeah.
convert right then as soon as it happens, and they have the option according to the contract to convert whenever they want to. But like it's kind of like a call option, right? It's basically a call option for them. These notes is they're a long dated 2029 call option that they can execute at 9:54, right? Like if you have a call that's long dated and it goes in the money by a pretty decent amount, and you're convinced that it might go further, right? You might want to wait to convert.
in the terms, SoFi can redeem at any time until March 2027 when it crosses 1228, but the note holders can only convert on certain circumstances until September 15th, 2028. Essentially, let's say the note holders can only convert once a quarter or twice a year or whatever. SoFi can just buy back all of those notes if they have the cash on hand if the stock is trading at 13 or 14. So note holders would be incentivized to essentially convert at their earliest convenience because there's always a chance that SoFi can just buy back the notes.
That's a really good point. And so that is in the contract that by 2027, so basically 3 years from now, SoFi has the opportunity to pay these off with cash for the principal plus interest is how the contract is written. My understanding of that is it's just for the 750 million. And so it seems like it's a little bit of a poison pill that they've inserted into the contract where if the stock is trading at $13, $14 and you're getting up to that point, that it's 2027, they would want to convert at that point because they'd rather have shares that are worth, or shares that they're buying or that are being delivered at a price of $9.54 but are worth $14 on the open market rather than having the chance that SoFi will pay them back with cash instead.
I guess one question that I had, where those shares are going to come from. So I've heard multiple different answers on this.
Mhm.
And the one that I sort of subscribed to was that the brokers have to purchase the shares in blocks over the next, say, couple of months to get an average price, and so that they would take them off the market. They would essentially be part of the float, but non-tradable, held by the broker up until that point where that cap is hit, at which point they could have them there for SoFi to exercise the options. Or the other option is that the broker does nothing, and if and when that price is hit, at that point the broker goes and buys the shares on the market. So I guess that's the part where I'm not sure, because the implication of that is this entire liquidity that's being sucked out of the total float, which could really spell trouble for shorts.
So this is the Uncle Bruce theory, we'll call it. So
Bruce
Uncle Bruce, who's another YouTuber, he has a lot more experience on Wall Street than any of us. So I think he probably knows what he's talking about. The Uncle Bruce theory, I'll call them theories. I don't.
UBT?
The UBT is that the people who sell these these capped calls to SoFi, they are obligated to deliver these shares in the event that the stock gets above that price. And so they are going to be gobbling up these shares in the open market so that then they can give them to SoFi when the capped call gets exercised. What he says is that they'll be buying, call it 80, 90 million shares on the open market over the next several months in order to cover their position. And that's possible. The other thing that I've heard, it's possible also that these people who are doing these capped call transactions, they're just going to be market makers. They're providing liquidity for the capped calls, but they're not taking a bet one way or the other whether SoFi stock goes up or down or whether the company performs. And if that's the case, then they would delta hedge, which basically means that the calls that are being bought have some sort of delta. We'll call it 0.3. And so what that means for people who aren't as familiar with options is if the stock price of SoFi goes up by $1, the price of the call goes up by 30 cents. So that's what 0.3 means. It means you multiply the movement of the underlying stock by the delta, and that's how much the price of the option changes. And so what they would do if the delta were, say, 0.3, they would say, okay, we're going to have to deliver 90 million shares theoretically at some point in the future. We will go out and we will buy 0.3 times 90 million, 30 million shares in order to cover ourselves. And then as the stock price goes up, they would purchase more shares because the delta goes up as the stock price goes up. Or if the stock price goes down, they would to be selling shares on the open market, and they'd just be acting as a market maker in that case. But that means if the stock price goes up, that means there would be buying pressure from them because they would have to get more shares in order to cover their position. But in either case, there's going to be some buying pressure in the near term.
I don't think this is necessary for a squeeze. I'm not invested for a squeeze. A squeeze might never happen. I wouldn't encourage people to invest banking on a squeeze. That can be very dangerous. You can be burned.
Okay, so I get the whole like UBT versus the delta hedging strategy. Either way, there's going to be shares that are going to go off the market periodically from the broker to cover the call. Sure. And that alone may not cause a squeeze, but I think that, can we all agree that institutions that took the other side of this deal that gave SoFi $862 million didn't do it for 1.25% interest a year? Like, what is their incentive? Obviously, they want to be owning the shares, correct? They are incentivized to convert. And if that is the baseline, which I think we all agree on that, if that's a baseline, can those same institutions just buy shares on the open market so as to drive the price up to their conversion, basically to ensure that they convert?
Yeah. So
I have no idea.
When's the earliest that they can convert if the price hits the 12.29 or whatever?
They have no
I
time.
believe July. It was in the contract today. I think it's in 2024. It's almost immediately.
Oh, wow. Okay.
So anytime if it's above that, whatever it was, 1227 for 20 trading days out of 30 days, including the last day of the month, it has to close above that price. It's all this confusingly worded lawyer talk. But if it gets above that price for call it a month, then they can convert starting this year.
Like if I were an institution and I'm, let's say, bullish on SoFi, let's say I'm Kathy Wood and I'm still buying anyways, and SoFi came to me and they said, hey, give me a loan. And what I'm going to do with that loan is I'm actually not going to dilute you as a shareholder, and I'm going to pay off some of my debts and actually help my bottom line. And you're still going to get the shares afterwards if the stock price hits a certain price by, let's say, July, if it hits $12. Then I'm like, okay, here's the money as a loan, knowing that when it hits 12, I'll convert, and I'm incentivized to do that. And I'm just adding to my position behind the scenes. Like, let's say I'm Kathy Wood, I'm buying SoFi stock every single day, adding, because I know those shares are going to end up being mine anyways. I'm incentivized to do this entire transaction to drive the stock price up, while at the same time, I'm giving money to the business to essentially help their cash flow, help their bottom line, help their balance sheet.
You brought up Kathy Wood. I think she bought somewhere over 5 million shares this week.
Yeah. It's tough to push it down as much. And I think that it went down as much as it did on that initial day, just because the lower the price went, the better it is for these people that are offering this money for SoFi up here, that are part of this senior convertible note thing. So
we should talk about that really quick too, actually,
go ahead,
before
Chris.
we sign off. I don't usually subscribe to conspiracy theories and manipulation on the stock market. In this case, it makes a lot of sense because basically the idea is the lower the stock price goes, the more shares these people get when they convert. And so if you would have taken this exact same transaction and you would have priced the shares based on the closing price last Friday, which was $8.99, they would have gotten 24% less shares than since it closed at 8 or 727 or whatever it was on Tuesday. And so they're getting way more shares, first of all. So that's the first incentive is, number one, they get more shares of SoFi because now their $750 million are being divided by 945 instead of being divided by like 1170 or something. So they get more shares. And then the second reason, and I actually didn't put this in the tweet, but I should have, is now their conversion price is also way lower, right? So they can convert at it. So if it closed at $9, they would have had to get up towards $15 in order to convert their shares. Now it's only like $12. So they get, number one, more shares, and number two, a much higher likelihood of that conversion price being hit. So there's two reasons that the institutions who now have $862 million on the line wanted the stock to go down. And it turns out that the stock had its worst day ever, which that's the part that was really nuts to me. Like, I understand there being news coming up, and the stock sells off 6-7% because people are confused about convertible notes. But like, I've been in this stock since it was IPOE. My first buy was like January or February of 2021. Right. So I've been invested in this through the whole way. We had Upstart miss and drop 50% in a day, and SoFi stock was dropping with it. All this inflation news, we had all this negative news. Never in all of those negative news did
Guidance
we drop
revised down.
15%. Yeah, the guidance and the student loan moratorium being extended over and over and over, and or SoFi having to drop their guidance because the student loan moratorium got extended. Like, you can count all these things that like fundamentally were really bad for the stock. And then you look at this news, which again, honestly, like, there's some bad parts, there's some dilution, but there's also a lot of positive things that resulted from this news. So my personal opinion is that it's neutral at worst and probably slightly positive what happened this week. But then the stock dropped 15.3%, which is worse than any day in the entire history of the stock. That doesn't make sense to me.
It was going to happen either way. It also happened for, like, Uber was massively down the day that they did an exactly the same deal, even though the deal was so over. I think they announced it at 1.2 billion, and they ended up oversubscribing, and it closed at 1.7 billion. Same thing with a capped call on top. And the stock took a big hit just because, first of all, exactly what Chris said, these institutions are incentivized to get out as low as possible so as to capitalize on the deal. And then from a retail perspective, all these people read the headlines and they're like, what? They're issuing more debt. Oh no, dilution, this and that. Like, it's perceived negative until you actually read into the details. How many people did we have just this week alone that just didn't understand this? It took us so long to understand it and to see it as the positive news that it actually was, right? And so I think the gut impulse is to treat this as negative news. But look at what happened to Uber since November of 2023 when they did that deal. The stock has almost doubled after that.
I
Rocket
honestly
Lab did
don't
the same
think-
thing. So Rocket Lab recently had a convertible note, and they dropped like crazy on the day of as well.
But we're gonna head over to the after hour show right now. Thank you so much. Bye for now.